Welcome, everyone. You are at an Entrepreneurs Forever deep dive, the first one of the year, which is why we have a topic to kick the year off, forecasting the year ahead. We'll do some introductions and talk a little bit about Entrepreneurs Forever. I used to leave telling you about the upcoming programs until the end, and then I found out I never got back to doing it. So I'm going to tell you before we do the presentation. So if it's interesting, you can sign up. Eli is our guest presenter. We'll talk for about an hour, and there's always dialogue and always time for questions as we go. But those of you who are regulars know that we record the front part and then we turn the recording off for the Q&A part, because we want you to be able to ask questions and get the real answer without worrying that it's getting recorded. So, Entrepreneurs Forever, our mission is to empower all small business owners to grow thriving businesses, to sustain their families, and support their communities. This deep dive program that you're joining is something I do monthly. I'm the senior program manager at Entrepreneurs Forever, and I try to keep my ears open and hear what people are talking about and our entrepreneur members are asking questions about. And this is one we hear all the time. I'm not great with the numbers. I don't know how to predict the year ahead. What can I do? And out of nowhere, honestly, I guess, did Doogie do the introduction? I think he did. One of our facilitators introduced me to Eli Santiago, who's the founder of Alpha Savings Consultants. And Eli's going to tell you a little bit more about himself. And the fact is, he doesn't really do what we're talking about today for a living, but he does it sort of incidentally as part of what he has to do for his clients. So Eli, why don't you just tell them a little bit about yourself and then we'll move forward.
Yeah, sure. Thanks, Deborah. And appreciate everybody who chose to join the session today. I'm assuming that there's a keen interest in developing some level of competence with respect to forecasting for your business, and we'll talk a little bit about that. My name is Eli Santiago, and I am the founder of Alpha Savings Consultants. As Deborah said, we don't really spend time with our clients in helping them develop cash forecasting, and that's not what we do. My background is in the healthcare industry. I spent a number of years as a healthcare executive in a number of different settings, hospitals, health plans, community centers, and so forth, primarily with bottom line responsibility. I was in operations for most of my life. Several years ago, I went into semi-retirement and joined a consortium of companies that essentially serve our clients by identifying where they can save on how much they're spending for the services that they buy without actually replacing who they're getting those services from. We just evaluate, because we have deep industry expertise in a number of areas, and evaluate whether or not they're overspending, overpaying, and whatnot, get them refunds, keep their existing vendors, and that's essentially what we do. I can talk a long time about that, but that's not what we're here for. We're here to talk about forecasting, and so why don't we go get right into it?
All right. View slideshow. All right. Because I know I'll forget later, here's the two next programs. Next one is the Forever Forward on Understanding Your Business Life Cycle. And that's going to be presented by my colleague, Katie McMahon, who's Vice President of Programming here at Entrepreneurs Forever. And then there's a new one that we're developing called Working with Your Financial Professionals. This one I think is a relevant follow-up to today. If you use an accountant, a bookkeeper, a banker, you have an investment advisor, you have an attorney who helps you on financial things, you have investors, you have a loan. These are the people you need to work really well with. And we're going to have a workshop next month on February 26th about working with your financial professionals. If you are not a member of one of our groups, we do have weekly discovery sessions, and you can sign yourself up online at our website. Okay, big disclaimer. I do this one every time. This presentation does not take the place of professional advice from your paid advisors, but hopefully it will give you a good start. Why this subject? Well, you can make better business decisions for the year ahead if you can be strategic about what you're going to do. So from here on, you're going to hear mostly from Eli with me as little gadfly here. So Eli, take it away.
Sure. So just as to set the table, my goal here is not to end with you becoming experts in forecasting of any sort. But I do want to whet your appetite about forecasting. I want to, we'll talk about some of the concepts that are involved in that. Look at some of the tools that are available. And if we have time, we'll actually run through some examples using some simple tools to show you how you can actually create a forecast for your organization. And as we're talking, fundamentally improved and informed decisions, we're really talking about eliminating much of the guesswork that goes into forecasting what your future is going to look like in terms of the next quarter, next month, or even the next year. You're going to rely on data that you have hopefully been collecting. There's a risk because if your data reflects current methods and how you operate, and depending on the quality of your data, you're going to be baking that into your existing forecast. So you're going to probably want to take a look at that to make sure that what is in existence today, what happened in the past, in fact, is still relevant for what's going on in the future. And there's certain things you just cannot include in a forecast, one of which is certainty. It's a forecast. It'll never be perfect. You can't even put things like what happens if an event that you just never planned for takes place. One of your key employees leaves, an illness takes place in the family, one of your major suppliers is gone, right? Things you can't really bake into your forecast. Do the best that you can. Next slide, please.
Okay.
Unless there's something you want to add to that.
No, you're doing great.
Okay. So when you look at forecasting, it's going to really help you take a look at the future so that you can make these kinds of decisions that you need to make. Nobody really wants to fly by the seat of their pants. You don't really have a crystal ball and you don't want to use tea leaves to forecast what you're doing. So these tools, you can, if you focus on putting together the effort, using budgeting, we'll talk a little bit about what that is. You can look at how can you predict what your sales is going to look like, whether or not you're a manufacturer, whether or not you're a service, or you could be providing litigation services, you could be providing IT support, whatever that is. What does that look like for 2024? And again, one of my most key to my business is cash flow management. And we'll learn that just because you're making money doesn't necessarily mean that you've got the cash and the resources to meet your obligations. As you pull these things together, you'll be able to look at, if you're manufacturing, do you have inventory? Do you have the right levels? Do you have to, are you overstocked? So what is the proper inventory levels that you need to keep? And resource allocation deals with things like, do you have enough people to meet the obligations that you're currently forecasting? If you're forecasting growth, do you have enough individuals? Have you hired? Do you need to hire? And when do you need to hire that? And again, planning for unexpected events to manage that risk.
All right. So we are gonna, if I can do this, launch a poll. So this poll is really just meant to give Eli and I a chance to understand. Everybody's seeing this on their screen? Yes. Okay, and I'll share the results in a minute. This is, how do you track the finances of your business? Please be honest, because we can't really make this work if you don't tell us what the real deal is. Okay, I do it myself with Excel, it's 33%. I do it myself with a program like QuickBooks is 33%. I use a bookkeeper or accountant to keep track with QuickBooks. My taxes get filed 0. So that's good. So really it's a third, a third, a third. Excel, I do it myself with QuickBooks, or my bookkeeper accountant uses QuickBooks. All right. So you guys saw that. I can move on. Here we go. All right. I have to stop sharing this. Sorry. I need to close it. Nope, sorry.
So
All right.
that was very, very encouraging to see that there are quite a number of you that are actually deploying accounting software packages, working with professionals, and certainly some of you are actually using Excel spreadsheets on your own. So a lot of what we say won't be foreign to you. So that's good to know. For the rest that are not that conversant, we'll try to keep this at a level where you can still see the value of it and consider deploying some of these tools for yourself. When you create forecasts, you're going to be dealing with two different types of documents. The documents are similar in nature in that you have a statement of income and expenses, which is a backward-looking document, as is the balance sheet. The balance sheet is simply a statement that tells whoever's looking at it, what is your company worth? It lists your assets, your liabilities, and the difference between those two is your net, your owner equity, your essentially your owner equity. Anyway, statement of cash flow from operations is another document that can be generated either by yourself or by accountant historically. When you take these documents and make them forward-looking, they're pro formas. And so a statement of income and expense becomes a budget. And the budget, obviously, you can develop for on a monthly basis. You can make it quarterly. You can make it for the entire year. And inclusive in that, you want to try to develop the cash flow statement forecast, which enables you to determine whether or not there are periods during the year where you might be a little tight on cash, and the reasons for that. What can you do about that? And we will have templates that you can actually access. One of them is in fact designed to help you develop a cash flow forecast. All you've got, it's a plug and play, enter the information, and it'll actually calculate for you what your cash position is going to be over the course of the next 12 months.
So Eli, my big takeaway from this one is when someone says it's a pro forma, I need a pro forma, what they're looking for is for you to project forward your budget and expenses, yes?
Exactly.
Okay.
And so there are different ways to tackle your forecasting. A simple forecast is one where you take a look at all the elements of your company, things like, what do you think your revenue is going to look like over the next period of time? And associated with that revenue, if you've been studying your numbers, if you got the numbers to study, you'll know that there's some correlation between that income number and what it's costing you to generate that, something called cost of goods sold. The other thing is that there are expenses that are not directly related to the actual sales activity that are operating expenses that you're going to incur anyway. So you make assumptions of each of these things and plug them into a spreadsheet or your software program, and it actually calculate out for you. Simple forecast. Scenario planning is a little bit differently. Like say, for example, I don't know what my sales are going to be in 2024. I think they're going to grow somewhere between 5% and 20%. As far as personnel, maybe the personnel salaries are going to go up by 5%. Maybe they're going to go up by 10%. Which one do you use? Well, you can actually pick one of those, plug them into your numbers, use another one, plug them into your numbers. So this way you can say, what if my forecast is for growth is at 5%? This is what it's going to result in. What if my forecast is at 15 or 20%? This is what the numbers are going to look like. So you can have a range, and then based on that, you can have a sense of where you might need to be. You're ultimately going to have to make a choice, but at least it gives you what if scenarios that if the best thing or the worst thing that happens, what you can do about it. Obviously, when you create these forecasts, you want to have an action plan surrounding that. so that you can make your forecast come to reality.
Okay.
So again, we talked about some of the applications, some of the tools that you can use. If you're using QuickBooks, QuickBooks does have forecasting capability. There's another package called FreshBooks. I don't know if you're familiar with that. Wave. So, and we'll give you a link that'll
Yeah, actually, the handout that everyone should have had, and if you don't, I'll resend it in a minute, has actually an overview of all the different packages, so you can see what they are. And we're not endorsing any of them. We don't get any affiliate fee, but these packages are pretty much standard for people as they get a more complex business.
Yeah, there's one in particular by PC Magazine that actually evaluates a lot of these different accounting packages. So you can take a look at that and certainly make the choices for yourself. So the types of forecasting, how many of you are familiar with these terms, straight line, linear regression, moving averages? Don't mean to scare you. You don't need to really become an expert in this. So we're not gonna get into linear regression or moving averages, but a lot of the software packages are actually embedded in those applications of some of these concepts, these statistical tools that actually create the forecast for you. Most of the forecasts that we'll be talking about are really going to be straight line forecasts, meaning if you know what last year's were and you think it's going to be pretty much similar to next year's going to be similar to last year, simply would take that last year's numbers, divide it by 12, plug those numbers into a spreadsheet, and that'll calculate out. From that, you can make modifications, so now I'm not sure this is going to happen in the middle of the year. You can make any adjustments there, but we're not looking at any sophisticated statistical tools for what we're talking about here. If you're not familiar with pipeline revenue forecasting, if you're in the business to sell if your business involves selling contracts for services, you may have a sales team, you may be the salesperson. You know what that's going to look like, you know which customers or prospects you have on the docket. You kind of sort of say, I think I'm going to land these contracts over a period of time. You can even attach confidence level. So let's say company X that you're targeting, maybe you're factoring that coming in the second quarter, but you're 50% sure that that's going to happen. You can multiply what that contract might generate in volume, in dollar volume by 50% to give you a little bit of a hedge on ensuring that your forecast is not overly aggressive. And then we got top-down forecasting and bottom-up forecasting. For top-down forecasting, that's typically used by the larger organizations. They look at macro things like, what's my market share going to be? Apple, for example, 20% market share, they can say that's going to be what it's going to be like in 2024. So they could use that as a basis for developing their forecast and working their way down. Smaller organizations or organizations don't have a whole lot of experience, a whole lot of business experience, usually start with, well, I've got X number of people working on this project. I've got inventory at these levels. And you can say, with that, I think I can forecast this volume of sales. So you start working your way up to aggregate up to a document that creates your forecast.
And I just want to point out, because I know a few folks on this call may have been through the E4All Accelerator program, which I actually wrote the projections class. We used to call it back of the envelope. And we spend time talking about this top down and bottom up. And especially if you're a solo entrepreneur, bottom up is the thing that usually makes the most sense. It's like, how much more could you possibly do as long as it's just you? And if it gets to be more than it's just you, then you need to forecast for the hiring of another person, et cetera. So those concepts should be familiar to you.
And typically, most organizations use a combination of both, because if you know that even though you're small in that particular market, if you know what's going on in the market, you can use what's going on in the market to assess where you want to go and give yourself some how confident you are with I mean, if you're projecting you're going to grow at 20%, but the market seems to be shrinking overall, that might not be a smart perspective to take.
Eli, there's a really good question from Peter Burson. Since we have 2/3 of the folks on this call are QuickBooks users or using some software, probably QuickBooks, what is QuickBooks default forecasting method?
That's a good question. Not exactly sure. I know that they have built into their software analytical tools that can be pretty sophisticated. I would suspect that they're using a bottom-up method of forecasting versus a top-down. But I'm not exactly, I couldn't be 100% on that.
Okay.
And then, you know, similar to what we talked about a minute ago, top down versus bottom up. When you just got started in business, maybe you got a year or two, you don't have a whole lot of information. You might be making your forecast based on kind of judgment, just making assumptions that aren't really necessarily data driven. The more data that you get, the longer you're in business, the more you can resort to quantitative models. Now, qualitative models doesn't necessarily mean you don't have numbers. It's just they're not necessarily backed up with data that you can say, I've got a reasonable level of confidence that over the last several years, this is where it's going, and I can use that as my foundation.
Okay.
So how do you start? Obviously, we've been mentioning the need to have data. It sounds like a lot of you do have through the applications that you use historical information. If you've got at least 1 year's worth of data, that's really great. The more years you have, the better it's going to be. When you look at your information, if you look at your revenue line, if you've gotten an accountant to prepare your cost of goods sold statement, in your financial statement, the cost of goods sold there's usually a correlation between your revenue number and the amount of the dollar amount on that line. That'll give you a good ratio that you can use. So if you're forecasting revenue growth of 5% and your cost of goods sold tends to be 50% of your revenue, then you start with that number and you can forecast that up as well. Obviously, you're going to be looking at whether or not you're going to experience any difficulties if you're in the business of making things, what kind of supply chain issues are you going to face? Fixed expenses, and why that's important. Whether or not you sell, you're still going to have to be paying your rent. You're still going to be paying your utilities. There may be some equipment that you've leased and so forth. These are expenses that don't vary with your activity, generally speaking. So knowing what those costs are is particularly important. So you keep that in mind as you put your document together. Hopefully, you have a pretty good handle on what your fixed expenses were for the prior year, because generally speaking, they're not going to go up very much. And you're going to have proposals from your vendors. They're going to tell you whether or not they're going to stay the same, but they're going to be fixed throughout the period.
And I'll just say that we did put a resource in the handout that was fixed versus variable costs. If you need a little refresher on that. When I teach the E4L class, I usually say a fixed expense is something you have to pay whether or not you sell anything. So that includes all the expenses of your LLC, paying your accountant, your bookkeeper, the rent, your car, your website, whatever things you're going to have to pay for anyway. And knowing what those are, maybe by looking at it, you'll decide you don't need to have an office anymore, or you don't need to have a store. But if you don't spend time looking at it, you'll never know.
Yes. And in fact, and if you decide that the number that it's in those line items is a number you can reduce, rather you eliminate it entirely, you can at least take a look at where you might be able to cut back on some of those expenses.
Okay.
So market conditions. We talked about top-down forecasting, and that's what's typically used in larger businesses, but every organization really needs to take a look at things that are happening in the economy. If you've been following the pronouncements by Jerome Powell last year, he changed interest rates, 3 or 4 times. When interest rates change, what happens to the cost of doing business? Well, typically they fluctuate in direct proportion to that. So you want to pay attention to that. What's going on with elections and who appoints the Fed chair, and is that going to change how you look at your forecast for next year? Is the competition doing something that you need to pay attention to? I was thinking about an example. How many of you are old enough to remember Blockbuster Video?
Oh, yeah, I remember it.
And if you remember, that was the only place to go when you wanted to rent a video. Suddenly, technology improves and they started to be able to stream movies with
Oh, first Netflix started mailing you DVDs. You remember that?
oh, the mailing. And what did Blockbuster Video do? Nothing. And so when streaming and mailing videos came along, it completely eliminated Blockbuster Video from the market. Looking at what's going on in the market, no matter how big or how small you are, is vitally important.
Yeah, when I think about the example you and I shared was if you are a donut or a muffin shop and you have a great local presence and you find out that Dunkin' Donuts is moving onto your block, wow, you really need to think about how is that going to impact you, because it will. I mean, there's some people who are just going to go to the drive-through and know that brand. So thinking and paying attention to those are very relevant for you.
Yep. Yep. And then when you are developing your scenarios, we talked a little bit about this, then obviously you have to decide what pricing strategy you're going to use for whatever it is that you're selling. There may be room in your price to increase it slightly, or maybe not, depending on what's going on in the market and what's going on with your competitors. But if there's an opportunity to do that, obviously it's going to change your top line revenue. If you've got a number of different services or products that you are providing, the question becomes which of these products, if you're keeping track of which product is actually generating more margin, can you emphasize one or over the other? Or is it that you're making more revenue on one that has lower margin, but maybe you're making it up in volume? Also, who's actually taking your product to market? Are there opportunities for you to make modifications in your distribution channel? They're using social media, for example, are using referral partners to generate business. And then again, what do you anticipate your business is going to do in terms of sales going forward to predict your growth rate? Supply chain issues can affect your material costs if you're in a business of, and just because you're in the service industry doesn't mean you're not going to incur material costs, because there are other things that you have to pay for that are affected by that as well. Hiring plans are particularly important because you can't just simply add somebody right away. If you know that your forecast says that in the middle of the year, your sales are going to increase, or you're forecasting a sales increase off a very substantial number, you want to know that ahead of time, because it might take you a month or 2 months to get the right people in that job. And in today's labor market, that's something to really pay attention to. So physical location, are you where you need to be? Are you cramped? Is it too much space? And so these are some of the things. This is kind of a laundry list of the things that you might want to take a look at, and they all can be translated into dollars and cents. That's a beautiful thing about all the decisions you make. They become numbers, dollars and cents. And these are some of the things that you can take into consideration.
Yeah, I think one of the things, and one of the reasons I put this workshop together for our members, is that it's easy to think you don't have control, but there are a bunch of levers that you can press to make some changes. I'm not saying I want you to use a cheaper, pretzel mix in your pretzels, but have you looked around? Would it change the dynamics and the revenue projections? Should you sell fewer products? Should you, get rid of some of the losers. There are so many things that you can change. So let's try. The vast majority think we're going to grow in a similar manner to last year. And 38%, 5 of you, big growth in the year ahead, remaining steady, 1, and feeling like we might be in for a downturn, 1. So I don't know. How does that fit with what you're hearing out there?
Yeah. What I'm hearing is, especially in the larger corporate environments, is that CEOs and CFOs are optimistic about 2024. There is a considerable amount of optimism in the economy right now. And whether or not that will continue, and as the year unfolds, if there are things that happened in 2020 that really, took the sales out of a lot of businesses. We hope that something like that doesn't happen again, but
Yeah, and they were unforecastable, right?
completely unforecastable. And yet I think that despite that, we still see that the economy, even last year, if the market is any indicator, pretty substantial growth. And a lot of people are still forecasting that that's going to continue into the second quarter of this year, when Powell will come out with his prognostication on interest rates. So I think there's a lot of optimism. The people who are forecasting growth, all the more reason for you to be very careful with your forecast and pay a lot of attention to what assumptions you're making in generating that forecast. This is simply a very simplistic way of looking at it. If you're using accounting software like the ones that have been mentioned, it's going to factor these things into it already. But just as an example, if your revenue for 2022 was 100,000 and 2023 was 120, the delta is 20%. And if you use that simplistic number, then you would forecast 2024. If that's the kind of growth you forecast, $144,000 in sales in 2024. Now, of course, that may or may not be aggressive, but 38% of you felt that you're going to experience some pretty significant growth. If 20% is that number, that's good. That's good news for you.
Well, 20% would be the same growth rate as last year. So they'd be predicting that they're going to go higher than that.
That's right. That's right. Because 20% is just sustainable. It's just sustainable. So this is Deborah, I'm not sure whether or not we were going to.
Yeah, you know what? I feel like we have a good crowd here. Let me just take everyone's temperature. Eli has a month-by-month worksheet. I told him to hold on to it and to see if you guys wanted to see it. But I really think we can learn a lot from watching him change some of these assumptions and see what happens to the variable. So I'm going to stop sharing. And I'm gonna let him start sharing on his screen. It's gonna be a little bit potentially complicated to watch somebody real time looking at an Excel worksheet, but I really think there's value in watching him show us how you change some of the forecasts. This worksheet will be attached in your, when I send you the recording. So if you wanna go and play with it yourself, you can as well. The month by month is coming, Kalpana. Here we go.
All right. So just to let you know, I am not an expert in Excel, and you don't have to be. I actually put this document together in about an hour. And all I did was use some basic formulas to construct this.
So why don't you walk us through what we're looking at, just so that we know what this worksheet is. And if you can make it a little bit bigger, that would be great. And the view should be able to let you. Yeah, there we go.
Okay.
All right.
So I used two different types of organizations. One is an organization that relies on its revenue from its service contracts. And the other one was an organization which actually is selling material, products, items, units, whatever you want to call them, widgets. I deliberately left these columns blank. I'm going to show you what would happen if I plug in some numbers that would represent your contract values and when those contract values will come into play. So I'm just going to fill in some numbers and you can see what's going on. Now, if I scroll down from here to this section of the spreadsheet, I don't know, if I could move it for some reason. Oh yeah, I could do it this way. The number I just plugged in came in at 2,000 in February, right? Where I put that number, because that is when you're going to actually see the income coming in. And so there it is in February. And then I continue to do that by putting in I put these numbers in prior, and I just wanted to start showing you what would happen if these are the revenue numbers from your contracts that you realized that you at least forecasted for the year.
And when you say contracts, you're assuming that a contract gets paid all in 1 month, and there's only one contract per month, right?
Well, that's the
Oh, no, that isn't what you've done. I see. You split it up in a few months.
I did. So, for example, the last one I just entered, you're going to collect, and I only did 6 months to make it simple. You can actually do this for the rest of the year. You would collect the 7,500 in 2 different time periods. Sometimes you collect it all at once. This is obviously purely fictitious. I did
Right.
this.
So Peter's asking if it's a recurring revenue, you would just divide it by all the months or however many months it goes for, right?
That's exactly correct. Perfect. Yes. And then, of course, if you were selling widgets or manufacturing, you had 3 different products A, B, and C, and you sold each of those products in January, February, March, and so forth. And then you had the pricing for each of these products. All you would have to do is enter a number, and it would recalculate the.
But you could also change that price. So let's say in March, you raise it to 11, right?
And let's say you did that, 11. And then, that, and it didn't affect your volume and sales. So you know what? Whatever you wanted, you can actually start to play with this to see what kind of impact it has on your actual revenue till you get to the saturation point. So what you'll see below here is I plugged in all those numbers above and it generated the revenue here. What I also did here, having assumed that you had 2022 and 2023 numbers for revenue and sales, estimating what your 2024 for the first 6 months would be, and just simply took the annual number and sort of projected what that could be in 2024 and made some assumptions. If you notice up here, your sales volume in March, April, and May are considerably higher than at the beginning of the year. And so I just, again, these are just, I plug numbers. I increased your direct labor costs in the latter 3 months of the year by some number, dropped them down in 2,000. You can make that 3,000 again, or 30, whatever the number is, and it'll ratchet that again. Materials cost plug based on your, I used 2022 and 23 just as a barometer to make sure that when I calculated 2024, that number 3,200 for materials is not too dissimilar for what happened in 2023.
Well, it seems a little low. So somewhere well, you're only doing 6 months.
6 months, yes.
So it's half, right? Okay.
Okay. And so you continued on down, and your cost of goods sold for 6 months in 2024, I'm forecasting about 23,000. That's 46,000 for the year. But with increased sales in 2024, you would expect that to change. It compares reasonably close to what happened in 2023, and we're projecting growth in this company in every area. So as you can see, your profit is simply a matter of, if I change any number in here, your profit's going to change. And
right. So the caution that I would have is that when you make one change in here, it may have impact in other places that you need to pay attention to. So let's say you add a new distribution channel, and now you're going to have much bigger sales, but you're also going to have bigger expenses that go with them. And potentially your revenue per unit is going to go down because you have to pay a commission to that distributor. So these things don't exist in a vacuum. They're all intertwined.
that's exactly right. If I could make a connection between sales and cost of goods sold, like make it a ratio, and I calculated a different number here, it would automatically calculate my cost of goods sold because it varies in direct proportion to your sales.
It usually isn't such a straight line for most people, but it also is sometimes a number that people like to keep an eye on. They want to make sure that their cost of goods sold isn't more than 50% of the price, right?
Exactly. And then your operating expenses are those expenses are not necessarily tied directly to your sales, but you're going to incur anyway. I made some simple assumptions that the rent is going to increase slightly over 2023, but not much, but it's going to be the same every month. And you see a similar type of entry for some of the other expenses. Just to give you a gut check, simplistic assumption that 2024's utilities are going to be exactly the same. And if you believe that, at the rate that utilities are going up, you probably that's not a valid assumption. So you might actually question, Eli, how could you forecast that? That utilities are going up by 10%. So maybe you might want to do some of these numbers. But it gives you an idea for what could happen if you and then your total is simply calculated. This spreadsheet is designed so that all you got to do, it automatically calculates your numbers down below, ratchets that down, changes your net income, changes your total for the year. And then your tax rate is simply 30% of your net income, taxes and interest, for example, and calculating your net income for the total year. From that, you see at the very top of here, summary, your income that came right from the numbers down below, your expenses summarized, your earnings before interest and taxes, your taxes and interest from the sheet below, and then ultimately your net income. Pretty simple.
And there's that net income is negative in some months, and we're going to talk about that when we talk about cash flow. Peter had a question he wants to talk about. When do you know when it's time to bring on another employee? But I'm going to bring that one, I think, up into the Q&A. But before I let Eli stop sharing his screen, I'm getting lots of compliments that people are enjoying watching you do this. Does anyone have any questions or things that they'd like Eli to demonstrate on this worksheet, which we will share with you?
And I want you to don't be afraid of the spreadsheet. If you look at this box that I'm in right now, you see up here at the corner, that's the formula for calculating that. I just plugged it in. Once I change anything in there, the formula, now I'm not going to change that because that's actually fed. If you notice this here, it's interesting. I'll show you something real quickly.
And then Kalpana, you can ask your question.
You see this box that I just highlighted? It says plus F76. If you want to check to see what's going on here, that little box, the little thing up here says precedence. You can actually tells you where that came from down here.
That's pretty neat.
So you can, and then, you can even say, well, that particular box, remove that arrow. Are there any dependents on that formula? Well, yeah, this formula down here depends on that number up here. So you can actually use this as a means of auditing whether or not your formulas were entered accurately and whether or not the dependents are set correctly, whether or not the items that precede that number were set correctly.
Okay, Kalpana, you want to ask your question?
Yeah, Eli, thank you for this amazing spreadsheet. I think this is so much helpful. This is going to be helpful, not just for this year, I think going forward. I guess like my question is, it might be I don't know, it might not be feasible, but I was wondering if I could reverse play this. Like, for example, I have a target of certain revenue for each of the month. Can I reverse engineer? Like, this is my, I don't know, like 10,000 is my goal for like the next 6 months.
How many units do I need to sell
Yes.
at what price to get to that?
Well, in some ways you really can do that. Like, let's go down here. I didn't go into this one because I didn't connect this particular model to the income expense projection, but you have different types of products.
So Kay,
Yes.
she sells
Yes.
different kinds of prepackaged meals for Indian
Okay.
food, right?
So let's just say there's just 3 of them.
Yes.
And let's just say that you plug these numbers into the mix and you say, well, you know what? That's telling me that for the first 6 months, I'm gonna earn $6,500 in revenue. But I really want more. You could actually play with these numbers. Let's say you keep the pricing the same and say, you know, I need to be more aggressive.
Yeah.
Let me go with, let's just change everything, right? How many do I really have to sell of each of these products in order to generate what? Twice that number. You could actually double all these and it will give you that new number. But the numbers that you finally get here, well, that's not practical. A doesn't sell as well. I've got to, so you can spend time with it. I would spend time with it and then plug away the numbers. What you could do with this case is you see where it says price per unit?
Right.
That's a number. You see where it says units?
Yep.
That's a number. But do you see this number? That's a formula. So what I actually could do is I could color the columns where you don't want to mess with. And then you plug in your own numbers. And actually, if you wanted to make it more than the 3, you could insert that in here, add your actual product types,
Yep.
add the price for the products, the number of units. And this is complicated because there's so many products for each month. If you want to make it for the entire year, you can eliminate a lot of the complexity and just use all your products, your price per unit, leave the formula intact. And instead of trying to figure out when it's going to happen, you could do that, but you could just say, what is it for the entire year?
Right.
So there's a lot of ways you can play with this.
Yeah, and Peter's actually suggesting to copy the sheet and then to reverse engineer the formulas so that they actually pop up with how many you need to sell to get backwards, which is a great idea too.
Great idea. When you copy it, save it into a different file number, a name, and this way you can always have the template, and then you have your what you're dealing with is scenario planning.
Right. Right. That's exactly right. Yes. Thank
Good
you.
idea. Okay. Any other questions about this? Because we haven't even gotten to cash flow, and that's really what he wants to talk about. All right, Eli, why don't you stop sharing? And he will be sharing that with me, and I will be sharing it with you. Okay, so you're on again.
I love this part. This is where you're running a business, you look at your financial statements, your income is great, everything's happening, and yet for some reason, something's wrong. You can't pay your bills. So what's going on? You can't take advantage of discounts that your vendors are offering you. Oh my goodness. Next month, it looks like I'm not going to meet payroll. I'm going to have to borrow. I'm going to have to take a loan, go to my brother-in-law, whoever it is you're getting your money from, because something's going on. And by the way, you never want to be in that last situation where you have insufficient cash to pay your
I
taxes.
did it. Good job. Pero los tienes que hacer.
Sorry, I muted her.
All right, so here we go on to the next slide. What's going on, right? So here's 2 companies. Boy, don't they look exactly alike?
They do to me.
They look, and so we go, what's going on is both companies, this is company A, generate $100 worth of sales, and that sale is being collected. Oh, can you see? You can't see my scroller. Across the top of this column, you see when the sale is being collected. If you go to the total column for that first month,
Oops, sorry.
for that first month, that $100 that where is it? What company?
Oh, I keep hopping on. I'm so sorry. There we go.
Company A, there you go. Company A collected $90 of $100 in sales they made in January. And every month you could see they made $100 in sales, and that's how they collected it. Nicely, they collected all 100 in February. They collected 90 of that for the March sales. And by the time you get to the end of the year, guess what? If you haven't collected that $10, you ain't going to collect it. That's called bad debt expense. And so you keep on going down, and at the end of the year, of the $1,200 in revenue that they made, they only collected $1,065, where the yellow shows how much they're going to be collecting in 2025. But your expenses didn't change. This is where your fixed your fixed operating expenses kick in. You're still going to pay the rent, utilities, and so forth. And look what happened to that net cash in bank for this company. Let's go to Company B. Company B, they've got a much more aggressive collection policy. They're collecting all their money within 2 months of the sales, same sales volume. They collected all but $50 of the sales in 2024, and that's going to be collected shortly after that. Except for the first month, when that's where you want to have a good starting cash balance in the bank so you can weather that kind of a problem. They never, ever went below. The net change in cash was always positive in that situation.
Which company do you want to run?
Is that a rhetorical question?
I guess it is.
So what we're talking about here is really a term that you should all be familiar with, and that's liquidity and solvency. And when we talk about liquidity, it's not just how much money you have in your bank. It's not just your bank statement. Liquidity really has to do with, do you have enough in short-term assets to meet your short-term obligations? Meaning, can you pay for these short-term obligations within 1 year? Solvency is a little broader than that. It means, can you meet your long-term obligations? But if you have liquidity problems in the short term, you can pretty much rest assured you're going to have solvency problems down the road. Next slide.
Mhm.
And so this is an illustration that shows you what liquidity in play really looks like. The top line is simply what's going on with your bank balances. The green bar, it tells you how much you're actually collecting each month on your sales. Below that line is what you're spending in the various expenses. And you can see the fluctuations are going to drive your cash in the bank. Very simple illustration. You can actually do this when you create a forecast. You can actually create a graph that looks just like this. Some of your forecasting tools in some of the software packages can actually do that for you. And so I wanted to quickly talk about liquidity measures. There's 3 different ones I wanted to focus on, with I hope you don't glaze over this. Some of you may already be familiar with this, but the current ratio is an indicator of whether or not in your current assets, can you meet your obligations that are due within 1 year? The formula for that, if you've got a balance sheet, you would take all your current assets, which include your inventory, your cash in bank, your marketable securities, and that kind of things, and divide that by your current liabilities for the things that are coming due, your accounts payable, any short-term debt that you have to pay, things of that nature. And that number will give you rise to a number. The benchmark for many industries is given on the right-hand side. If you want to get even more conservative, the quick or acid test ratio says, let's take inventory out of the mix because you can't convert inventory to cash right away. If you subtract that from your current assets and you divide it by the same number, that gives you the degree to which your cash or your cash equivalents can cover your current liabilities. And typical benchmarks for that are 1 or greater. You can do these numbers. I'll show you real quickly.
And we'll do them in a minute. And it's also on your handout what some common ratios are, so you can look at what those are in an industry.
And I don't know, does that handout have a link to the, good, because you can actually go online and pick an industry and it can tell you, because every industry has a different benchmark. And so you don't want to use these necessarily for yours, but these are typical benchmark. Cash ratio is just that. Cash, now what is cash? Cash is obviously money. It's also, if you have money market funds, if you have treasury bills that can be quickly converted into cash or sold on the market, stocks and bonds. All these things are available for quick conversion to cash. You take that number divided by the current liabilities, and that's when you get the cash ratio for evaluating how you can pay your short-term debt with your cash and cash equivalents.
And Peter was asking for a service business. I guess the acid test wouldn't make sense because there's no inventory, correct?
Exactly.
Okay, so we created sort of this fake balance sheet, not that you need to know anything about it, except we use these as numbers for the calculations you're going to see on the next slide.
And so the numbers that you see on this slide came straight off your balance sheet. Typically, your accountant's going to prepare a balance sheet for you. So you'll be able to identify every single one of these lines. And in the example that we showed, they had current assets of 24,000, 18,000 in liabilities, current liabilities. They gave them a current ratio for every dollar. And for every, that means that the company has $1.33 for every dollar that they have and liabilities. Based on the benchmarks that we showed before, in this particular case, it's slightly below the benchmark. The asset test, they subtract an inventory from your current current assets divided by the same current liabilities, and it says that you have more than enough cash to cover your current liabilities. And finally, the last ratio took and only looked at cash equivalents, and it shows in this particular case, if your benchmark is 0.5, that 0.89 is really, really good.
Great.
Now, cash, managing your cash, the number of different things you can do. Company B was doing a good job in collecting their accounts receivable and eliminating their bad debt. By the way, the longer you leave a customer out there with collecting your receivable, the greater the chances that that's going to become a bad debt. You also want to make sure that when you if you're selling on credit, that you have an automated system to get those invoices out immediately, because that's time is money. If you can automate that, there are a number of software applications out there that can actually take and automatically, not sure what happened to the screen, but
Oh, sorry. There we go.
thank you. And then again, if you can, it eats into your margin, but you may want to get your money back quicker by offering your customers discounts for early payment. But make sure you set very clear expectations with the people that you're doing business, that you're offering credit to. And you can also adjust your pricing, as Kay's had alluded to earlier, obviously within reason, because you want to remain competitive. On the expense side, you got vendors. Can you negotiate discounts with them? Can you develop a payment plan that stretches out your payments? So instead of paying them in 60, you can pay them in 90 days. That's slowing down your payments without, again, harming your vendor relationships. Some vendors are more receptive to that than others. Inventory management, critical. Inventory is money. You've got money tied up in that inventory. When you look at your forecast, if your forecast tells you what kind of inventory you should be carrying, try to manage to those numbers. And what do we have here? Again, go to the financial markets. You can, instead of buying something, you could lease it. Make sure that you've got substantial amounts of cash. It's not lying idle. Even a savings account is better than not. But
I mean, interest rates aren't terrible right now. So if you have $10,000 in working capital and you can be earning 5% on it, go get it.
Go get it. Go get it. And then, lines of credit are things that you can use. You don't have to use them, but just in case you've got a period when revenue collection is slow, like we showed in that slide before, just because you have a negative cash flow doesn't mean that that's a bad thing. If you've got a line of credit that you can justify to your loan officer that this is temporary, then you can tap into that. It does increase your cost of doing business, but it gets you through that period of time. And certainly having an emergency fund, some people recommend that 3 months worth of current liabilities is if you can do that, would be something that you can try to maintain. And obviously forecasting.
Which is what we're here for. Okay, I'm going to stop sharing. And there's some really great questions in the chat. So I'm going to stop the recording so we can get to them.